Hey everybody, welcome to the daily analysis video. It is April 6th and was it a wild session today? We were busy on the swing trading front and we were certainly busy in the day trading room. We banked 5 for 5 in day trade today and we positioned ourselves nicely with some additional adds to our portfolio, some new shorts, and this is exactly what we were anticipating. We've said it in our past videos, the final nail in the coffin for this market that truly starts the next down leg is the word QT, quantitative tightening. And although this shouldn't be new for investors and traders, for some reason this bear market bounce, it's made people forget that we're still in an economic tightening cycle. And since we've officially got it in writing that now the Fed is going to begin quantitative tightening in the form of $95 billion per month, that is certainly going to be a headwind for the market. So you have to think about it like this. The last 3 years, especially the last 2 years, 2020 and 2021, the massive COVID rallies, when you think about the money that was printed and stimulated in the system, it inflated stocks. So naturally, when you do the opposite and you're withdrawing money from the system, you're going to deflate stocks and asset bubbles. And that's truly what I think we're in for, is a massive deflation in asset values. And it's really needed with inflation rising rapidly to 40-year highs. And you can bet that the April month-over-month data is going to push the year-over-year data to a new all-time high. Or sorry, not a new all-time high, but a new, 40-plus year high. Once again, coming in probably at least over 8%, since it takes into account the commodity shock that we've recently experienced in nickel, tin, steel, lumber, natural gas, oil, wheat, and you name it. Everything can go on and on and on. But let's jump into the price action of the S&P 500 here. We had some whipsaw action today, and it was some tremendous action. So right away we gapped down in the pre-market, sold off. You were flagging sideways here, broke down, completed the bear flag move, but then you started to chop just above this gap fill area. You did not come down to completely fill that gap on the initial sell-off, and we were waiting all day long to buy it or to buy this gap fill, but you never ever completed that gap, which left me so, it left open the door for potential more downside to come, because naturally when you're this close to a gap, you're going to come fill it. It's like a magnet. Every time you're just hovering over a gap, the price action is highly probable for it to come down and fill that gap, so you can start completing the next move, whether that's a small bounce up to this gap fill, which I think is likely, and then potentially starting to roll over. So that being said, whipsaw price action, you can see this is when the Fed minutes came out. You had this fake rally. We actually started shorting going into it at these pivot highs, and you had this huge reversal, so that was a lovely, lovely trade. And then you had this bounce, and that was the final gap fill flush that we were looking for. We actually picked it up right on the gap and down at this pivot high on this green line for a nice couple of day trades, and you can see that it just floated up and is flagging sideways. Now, the bigger macro trend pattern is still bearish. That being said, if we go to the daily chart, I do think it is very likely. Let's just remove some of these fib lines. So you filled the gap, which is lovely to see. That being said, you have a new gap that is formed up here. So I do think you have to go fill that gap up there before you start the next rollover period. So whether or not we come back down here to bounce off of this trend line, this is going to be your major zone of support. It coincides with the 50-day, more or less. But I do think you could potentially flush tomorrow a little bit, create like a little mini intraday double bottom before you go up to fill this gap, and then start the next down leg. The next down leg, in my opinion, is absolutely coming. I am now certain, now that I've heard the QT and actually the Fed putting together a plan, that I thought, $95 billion a month, when you think of it, it's not that much in the grand scheme of what the Fed has printed. So when you take that into account, the fact that they were printing $120 billion a month for basically I think it was 18-month period consistently. That's a substantial amount more that you have to withdraw. So inflation isn't going to be a quick battle unless we get a recession. If we get a recession, inflation will be nipped in the bud pretty quickly. If it's a nasty, mean one, then it will definitely, um, you know, nip inflation in the bud and really take asset bubbles out of the equation, which is the inevitable problem here. And I certainly think that stocks are going to go lower on this decline than people expect. That is just my, I guess, forecast, if you will. So I'm looking at the QQQ here, also some whipsaw price action. You had yields rising early in the day, which was putting pressure on tech. You can see this gap down again. You break down, flagging sideways, had this initial pop into the FOMC meeting, and then a drop, and then a pop back up. But ultimately, you're trading in this no man's land bearish channel now. Again, I do think you go up to fill the gap here at the 361. Look for an amazing shortable level there. That's going to be a great intraday level to short the indexes once again, because you're relatively still high to this. You're still close to the peak of this move, and I certainly don't think the markets are going to be taking out this peak, especially with the indicators that are on the horizon. Another thing we'll go over in this chart in this video is lumber. The lumber price is very, very, very accurate in predicting potential economic decline, specifically in the real estate market. And let's just pull up lumber actually for a second. That's natural gas, US 10, lumber futures. Okay, so this is very interesting price action for lumber. So notice here, this is your blow off, your QE top, and then it started to collapse. And this is kind of your second basing rally, which didn't completely take out the all-time high. So you know that you're heading into a downtrend for lumber. Whenever a cycle completes the downside and a new one starts the upside, you're always looking to make a series of higher highs. If you fail to make a series of higher highs in the new cycle, and the new cycle point starts at the low and obviously goes to the high. So if you didn't take out the high, which we clearly didn't, this pattern suggests that there's likely a high probability of making a new lower low. On the charts, charts and asset classes always want to make these extraordinary swings. They're looking to always form a higher high or a lower low. And that is across most and all asset classes. No matter what chart it is, they're always looking to make a higher high or a lower low. And you can see here we clearly did not make a higher high compared to the 21 cycle. We did a lovely 618 retrace just above, to be honest, and filled some key gaps on the way down, on the way up there. And now we have this beautiful double top. And notice that this is an M top, okay? It's a classic topping pattern. And when it triggers, which is basically this trend line here connecting the so-called neckline, one could argue that this is actually your neckline because you have your major pivot there. So we have technically triggered and confirmed below with this clear candle lower. That being said, the potential downside move in lumber, if you just naturally take the calculation without doing any math, the completed move that lumber should see should be down to the 529 level. That's almost a 40% drop from current levels. And when you think about the move and where it was at 1350 to now down to 878, that's roughly about I would say a 35% move, 34% move from this peak. So it still has a substantial way to fall. Now, the thing is that when lumber falls, you often have these housing crises. Notice this at the end of near the top of the tightening cycle. In 2018, lumber corrected significantly. Let's go back to the 2008-2009 cycle. So 2008, the housing crisis starts. Notice how lumber was a leading indicator. It was just slowly declining in the housing market. And here in August of 2008, when the housing market was when the housing bubble was announced, you had this big gap down and this eventual bleed. So as lumber declines, the probabilities dictate that a real shock to the housing market is in store, and it makes sense with a rising rate environment, with asset bubbles at the prices that they are. It certainly makes sense that you need to have a major correction in the form of 10 to 20% in the real estate sector. That being said, talking about the QE, the fact that the Fed is now reducing $95 billion a month from their balance sheet, keeping an eye on the repo market is going to be key, because that's another way for them to increase their balance sheet, but in an indirect way. And it's kind of, again, this fractional reserve banking. There's all sorts of little intricacies that pump the system full of money, but it doesn't affect this index and it doesn't affect that. So there's a lot of moving parts to analyze and watch. But the fact that they have expressed a tightening of their balance sheet and reducing it is certainly going to be a headwind for the markets. When you think about how much they've printed, they've roughly expanded their balance sheet from $4 trillion going into 2020 all the way up to $9 trillion as of today. So that's a $5 trillion increase. And when you look at the previous cycle in 2018, when the Fed was reducing their balance sheet, selling off assets, quantitative tightening, they were able to do so in a very small fashion. As history shows, the Fed has never been successfully able to reduce their balance sheet by the way that they inflated it. So when you look back at 2018, I think they were roughly between 10 to 15% reduction in their balance sheet. That's how much they reduced their balance sheet from the previous inflationary cycle. So if you apply a 10 to 15% reduction on today's balance sheet, 10% reduction off of $5 trillion is roughly $500 billion that they should withdraw from the system. So again, when you think about that, they've inflated by $5 trillion, and they've in the past cycles they've been very hard pressed to reduce their balance sheet. It just shows you that statistically and historically speaking, the likelihood of them being successful in being able to lower their balance sheet to the necessary levels that we need to really make an impact on inflation, I think is a very, very long, opportunistic approach. I think they're being way too optimistic in their approach, and certainly I don't think they're going to be able to reduce the balance sheet by any level that is deemed necessary. So we'll monitor it, how it goes. Eventually they will pivot to loose policy, but I think we're a long way from there, and we'll certainly be analyzing and watching for that policy trend. And let's face it, our markets aren't a free market anymore. They're completely driven by what policy cycle we're in, and it's these up and down, loose to tightening policy periods that create the volatility. And that's why, as an investor, it's certainly, the times have changed in the sense that what has traditionally worked, a 60-40, portfolio that has typically worked over the last 30 to 40 years is no longer working. It's getting crushed. Anything in the fixed income market is getting crushed. And it certainly poses a lot of risks and opportunities at the same time. Looking at the IWM gapped lower on the daily chart, you actually broke key support, which is your 50-day. And this is something to observe. Notice how you're trading, you close below the 50-day on the Russell, which is made up of the 2,000 smaller cap stocks. And notice on the QQQ, you held the 50, okay? And the SPY, you held the 50 as well. So often the Russell is the leading indicator. Typically the price action of the Qs and the spiders follow that price action. So this is pointing towards more likely downside, the fact that you're close below the 50 and the two other indexes you have not yet. So once you break this key support, ultimately you're going to be coming down to test these lows and these lows here. Eventually you will break. Now you could get a potential bounce at these levels, but I don't think it's going to be as robust as something like this. Just keep that in mind. These bounces that we will get along the way are designed to raise cash. You sell into the strength, And we exited our long positions long ago, and in the grand scheme of this move, because this was starting to get suspect. It was all in light volume, and look how quickly we reversed those gains. That just shows you that the price action on light volume can't be trusted moving forward.